Your first Social Security check of January 2026 is about to hit your account, and while you might see a bigger number at first glance, 7 hidden budget surprises are lurking beneath that deposit that could completely change whether you're actually getting ahead or falling behind this year. Point 1. Social Security benefits are rising 2.8% in January 2026. That's about $56 more every single month in your pocket. Point 2. A brand new senior tax deduction may slash your taxable income if you're 65 or older, potentially saving you hundreds or even thousands of dollars in 2026. Point 3. But here's the catch: rising Medicare premiums and exploding healthcare costs may completely wipe out your Social Security benefit increase, leaving you with less money than you think. Stay with me for the next 15 minutes because what I'm about to reveal could mean the difference between a comfortable 2026 and a financial crisis you never saw coming. Before we dive into these 7 critical budget surprises, this video is intended for educational and informational purposes only and does not constitute financial, tax, legal, or professional advice. While every effort has been made to ensure accuracy using the latest official information from the Social Security Administration, Centers for Medicare and Medicaid Services, and IRS guidance as of December 2025, individual circumstances vary significantly, and tax laws and benefit calculations can be complex. For personalized guidance regarding your specific Social Security benefits, Medicare coverage, or tax situation, please consult directly with a qualified tax professional, certified financial planner, or contact the Social Security Administration at 1-800-772-1213. This channel, Income for Seniors, is not affiliated with or endorsed by any government agency. Always verify information through official channels before making important financial decisions. If you're one of the 75 million Americans who receive Social Security or supplemental security income, your January 2026 payment is going to look different than what you've been receiving all year. And I need you to understand that bigger does not automatically mean better when it comes to your actual purchasing power and financial health. According to the Social Security Administration's official announcement, benefits are increasing by 2.8% across the board, which sounds like good news on the surface, lifting the average retired worker's monthly check from $2,015 to $2,071. That's $56 more per month on average, which over the course of a year adds up to $672 additional dollars in your pocket. But here's what almost nobody is talking about, and this is where those 7 budget surprises come into play. That extra money is being pulled in multiple directions simultaneously by Medicare premium increases, new tax rules, changing earnings limits, and rising healthcare costs that are happening at the exact same time your check is growing. Recent reporting from The Street, CNBC, and multiple financial analysis sources has revealed that when you stack your COLA increase against higher prices for groceries, rent, healthcare, and basic necessities, many retirees are discovering they're not actually getting ahead at all, and some are even falling further behind, despite what looks like a raise on paper. So let's break down all 7 surprises one by one so you know exactly what to expect when that first 2026 payment arrives. The first surprise that's catching many beneficiaries off guard is that while 2.8% sounds decent, it's dramatically smaller than the massive 8.7% cost of living adjustment we saw back in 2023, which was the largest increase in over 40 years. That 2023 COLA happened because inflation was running extremely hot, with prices skyrocketing across every category of goods and services, forcing Social Security to implement an unprecedented increase to help beneficiaries keep pace with their exploding living costs. In 2024, the COLA dropped to 3.2% as inflation began cooling down, and then in 2025 it fell further to 2.5%. Now in 2026, we're seeing a slight uptick to 2.8%, which the Social Security Administration calculates based on something called the Consumer Price Index for Urban Wage Earners and Clerical Workers, or CPIW for short. They measure changes in this index during the 3rd quarter of each year, specifically from July through September, and whatever percentage increase shows up in that index becomes your COLA for the following year. The reason this matters as budget surprise number 1 is psychological and practical. After experiencing that massive 8.7% boost just a couple years ago, many seniors have mentally adjusted to expecting larger increases. But we're now in what experts are calling a normalization period, where COLAs are returning to more historically typical levels, usually ranging between 2 and 3% annually. According to analysis from the Senior Citizens League, while any increase helps, this 2.8% adjustment is barely keeping pace with the actual inflation that seniors experience in their daily lives, particularly when it comes to food, housing, and healthcare, which tend to rise faster than the general CPIW index measures. The bottom line for your budget is this: if you are hoping for another massive COLA like we saw in 2023, you need to reset those expectations and understand that $56 more per month, while helpful, is not going to dramatically transform your financial situation, especially when the other 6 surprises start eating into that increase, which brings us directly to surprise number 2. This is the surprise that's going to shock most people and significantly reduce the impact of your COLA increase. The Centers for Medicare and Medicaid Services officially announced on November 14, 2025, that the standard monthly Medicare Part B premium is jumping from $185 in 2025 to $202.90 in 2026. That's an increase of $17.90 per month, or 9.7%, which represents the second highest premium increase in Medicare Part B's entire history. Let me put this in perspective for you. Your Social Security check is going up by an average of $56, but if you have Medicare Part B, which most Social Security recipients do, your premium increase is eating up nearly $18 of that gain right off the top. That means your actual net increase after Medicare premiums is only $38.10 per month, not $56. According to Mary Johnson, an independent Social Security and Medicare analyst, this premium hike is one of the steepest increases beneficiaries have seen, driven by rising healthcare costs, increased utilization of medical services, and adjustments required under federal Medicare law, including changes tied to the Inflation Reduction Act. For most Medicare enrollees, these Part B premiums are automatically deducted directly from your Social Security payment before you ever see the money, which means the impact is immediate and unavoidable. The standard rate of $202.90 applies to individuals whose yearly income in 2024 was $109,000 or less, and to married couples filing jointly with income of $218,000 or less. If your income was higher than those thresholds, you'll pay even more through what's called IRMI, or Income-Related Monthly Adjustment Amount, which can push your Part B premium anywhere from $284.10 all the way up to $689.90 per month, depending on your income level. Now here's a small piece of good news in this otherwise painful surprise. There's something called the Hold Harmless provision that prevents your Medicare Part B premium from reducing your Social Security benefit below what you received the previous year. However, and this is critical, certain beneficiaries are excluded from that protection, including new retirees who are enrolling in Medicare for the first time, people with higher incomes who pay IRMA surcharges, those who aren't receiving Social Security yet, and dual beneficiaries. CNBC reports that if you don't fall under Hold Harmless protection, your Part B premium increase could completely wipe out your COLA, leaving you with the exact same net payment or even less than you received in 2025. Additionally, the Medicare Part B deductible is also increasing in 2026 from $257 to $283 annually, which is another $26 you'll need to pay out of pocket before Medicare coverage even kicks in. And let's not forget that many beneficiaries also have Medicare Part D prescription drug coverage and possibly Medicare Advantage plans, both of which have their own premium increases in 2026. And unlike Part B, there is no hold harmless provision for those deductions, meaning they can reduce your Social Security payment below prior year levels. The Senior Citizens League warns that when you add up all Medicare-related costs, some retirees will see their entire COLA increase consumed by healthcare expenses alone. Now let's talk about surprise number 3, which is actually potentially good news for many seniors, though it comes with significant strings attached and won't help everyone equally. President Trump's tax and spending legislation, officially dubbed the One Big Beautiful Bill and signed into law in summer 2025, introduced a brand new $6,000 tax deduction specifically for Americans age 65 and older. And this deduction is in addition to the existing standard deduction that seniors already receive under current tax law. To qualify for this new deduction, you must reach age 65 on or before the last day of the taxable year, which for most people means December 31st, 2025. The deduction applies to the 2025 tax year, which you'll file in 2026, and it continues through the 2028 tax year, making it a temporary provision that will need to be renewed by Congress if it's going to continue beyond that point. According to reporting from Fast Company and AARP, the full $6,000 deduction is available to single filers with modified adjusted gross income up to $75,000 or up to $150,000 for married couples filing jointly where both spouses qualify. If your income is above those thresholds but below $175,000 for single filers or $250,000 for married couples, you can still claim a reduced deduction that phases out gradually. Here's why this matters for your Social Security budget. A significant portion of Social Security benefits can be subject to federal income tax if your combined income, which is your adjusted gross income, plus non-taxable interest, plus half of your Social Security benefits exceeds certain thresholds. Currently, single filers with combined income between $25,000 and $34,000 may have up to 50% of their Social Security benefits taxed, and those over $34,000 may have up to 85% taxed, with similar thresholds for married couples. This new $6,000 deduction could significantly reduce or completely eliminate federal taxes on your Social Security income, which for middle-income retirees could mean hundreds or even thousands of dollars in tax savings. Investopedia reports that for someone whose income puts them right at the edge of these tax thresholds, this deduction could be the difference between paying substantial taxes on Social Security benefits and paying little to nothing. However, there's a major catch that serves as part of this budget surprise. Higher-income retirees who are already above the phase-out limits will see little or no benefit from this deduction. Financial experts quoted by CNBC emphasize that strategic tax planning becomes crucial here. If you have control over certain income sources like IRA withdrawals, capital gains from investments, or part-time work earnings, you may be able to time these income events to stay under the key thresholds and maximize the benefit of this new deduction. For instance, if taking a large IRA distribution in 2026 would push you over the phase-out limit, you might consider splitting that withdrawal across multiple years to preserve your eligibility for the full deduction. It's also worth noting that this deduction will have a significant long-term impact on Social Security's finances. According to analysis from the Social Security Chief Actuary, this temporary deduction is projected to cost Social Security $168.6 billion in lost tax revenue over the next 10 years because federal income taxes on Social Security benefits go directly into the program's trust funds. The actuary estimates this provision could hasten the depletion of Social Security's trust funds by up to 6 months, potentially moving the retirement and survivor funds projected shortfall from the first quarter of 2033 to the fourth quarter of 2032. While that's a concern for the program's long-term solvency, in the immediate term, if you qualify for this deduction, it represents real money back in your pocket when you file your 2025 taxes in early 2026. The bottom line for your budget planning is this: you absolutely need to work with a qualified tax professional or use reliable tax software to determine whether you qualify for this new senior deduction, how much you can claim, and whether any strategic moves before year-end might increase your eligible deduction amount. This could be one of the few bright spots in your 2026 budget picture, but only if you take advantage of it properly and understand the rules. Surprise number 4 might seem minor, but it's causing confusion and cash flow issues for many beneficiaries who don't understand Social Security's payment schedule system. Your first 2026 Social Security check does not arrive on January 1st, and depending on your birth date, you could be waiting until late in the month to see your increased payment, which matters tremendously if you have bills due early in January and you're counting on that extra $56. Here's how the schedule works for regular Social Security retirement and disability beneficiaries. If you were born between the 1st and 10th of any month, your payment arrives on the second Wednesday of January, which is January 8th, 2026. If your birthday falls between the 11th and 20th, you'll receive your payment on the third Wednesday, January 15th, 2026. And if you were born between the 21st and 31st, your payment date is the fourth Wednesday, which is January 22nd, 2026. This birthday-based schedule has been in place for years, but every January there's renewed confusion as people expect their money on the first of the month and then panic when it doesn't appear. Now here's where SSI recipients have a completely different experience that actually works in their favor. If you receive supplemental security income, your first increased payment arrives on December 31st, 2025, not in January at all. The reason for this is that SSI payments are always scheduled for the first of the month, but when the first falls on a weekend or federal holiday, the payment is moved to the last business day of the previous month. Since January 1st, 2026 is a Wednesday, but it's a federal holiday for New Year's Day, SSI payments get bumped back to December 31st, 2025, meaning SSI recipients actually get their COLA increase a day earlier than regular Social Security beneficiaries. For your budget planning, you need to mark your specific payment date on your calendar and plan accordingly, especially if you have automatic payments, rent, mortgage, or utility bills that come due early in the month. Don't assume you'll have access to your increased Social Security funds on January 1st, because unless you receive SSI, you won't. Also, if you haven't already enrolled in direct deposit, now is the time to do so. Direct deposit ensures your money arrives on the correct date without any mail delays, lost checks, or theft issues. Surprise number 5 is critical if you're receiving Social Security benefits but haven't yet reached your full retirement age and you're continuing to work, whether full-time, part-time, or through self-employment. Social Security has something called an earnings test, and the limits for how much you can earn in 2026 before your benefits start getting reduced have increased, but many people don't realize this rule exists until they've already lost benefits. Your full retirement age, or FRA, is currently somewhere between 66 and 67, depending on what year you were born, and this is the age at which you can earn unlimited income without any reduction to your Social Security benefits. However, if you claim benefits early, which many people do as soon as they hit age 62, and you continue working, the earnings test comes into play. According to the Social Security Administration's official 2026 figures published on their website, if you will be under full retirement age for the entire year of 2026, you can earn up to $24,480 without any penalty, which is an increase from the 2025 limit of $23,400. That works out to roughly $2,040 per month on average. Here's the painful part. For every $2 you earn above that $24,480 threshold, Social Security will withhold $1 from your benefits. So if you earn $30,000 while under full retirement age, that's $5,520 over the limit, which means Social Security will withhold $2,760 from your annual benefits, effectively reducing your monthly checks until that amount is recovered. Now, there's a different, more generous limit if you're going to reach your full retirement age during 2026. In that specific year, the earnings limit jumps dramatically to $65,160 for 2026, up from $62,160 in 2025, and the withholding ratio is better. Social Security only withholds $1 for every $3 you earn over this higher limit, and this rule only applies to earnings before the month you reach full retirement age. Once you actually hit your FRA, the earnings test disappears completely forever, meaning you can earn $10 million a year if you're fortunate enough, and Social Security won't reduce your benefits by a single penny. Here's the good news that many people don't realize. The money that gets withheld due to excess earnings is not permanently lost. When you reach full retirement age, Social Security recalculates your benefit amount to give you credit for the months when benefits were withheld, essentially returning that money to you gradually over time through a higher monthly benefit for the rest of your life. However, in the short term, if you're counting on your full Social Security check every month and you go over the earnings limit, you could face serious cash flow problems when those benefit reductions hit. AARP and the Senior Citizens League both emphasize that if you're planning to work while receiving Social Security before your full retirement age, you need to carefully track your earnings throughout the year and stay in close contact with the Social Security Administration to report your income, because if SSA doesn't know about your earnings in real time, they may not withhold enough, and then you could face a substantial overpayment that you'll have to repay later. For your 2026 budget, if working is part of your plan, make absolutely certain you understand these earnings limits and factor potential benefit reductions into your monthly cash flow projections. Surprise number 6 primarily affects workers who are still paying into the Social Security system rather than receiving benefits, but it's important to understand if you're still working or if you have adult children contributing to Social Security, because it impacts how much they're paying in taxes. Social Security is funded by a 12.4% payroll tax on earnings, split equally between employees and employers at 6.2% each, or paid entirely by self-employed individuals as part of their self-employment tax. This tax rate is not changing in 2026, but the maximum amount of income subject to Social Security tax is increasing significantly. According to the Social Security Administration's wage base announcement in 2026, you'll pay Social Security taxes on earnings up to $184,500, which is an increase from $176,100 in 2025. That's an increase of $8,400 in taxable wages. Any earnings above that $184,500 threshold are not subject to Social Security taxes, though they are still subject to Medicare taxes, which have no wage cap. For your budget, if you or someone in your household earns above the old wage base but below the new one, you'll be paying Social Security taxes on income that was previously exempt, resulting in a larger tax bill. Specifically, if you earn exactly $184,500 as an employee, you'll pay an additional $520.80 in Social Security taxes in 2026 compared to 2025. If you're self-employed, you'll pay double that amount since you're responsible for both the employee and employer portions. This wage base increase happens every year and is tied to national wage growth trends designed to ensure that Social Security remains adequately funded as average wages increase across the economy. While it doesn't directly affect your Social Security benefit check, if you're already retired, it's worth understanding because it impacts overall program funding, and it matters if you're still in the workforce or have family members who are high earners. The 7th and perhaps most frustrating budget surprise is one that catches many retirees off guard year after year. The 2.8% COLA increase you're receiving in 2026 may not actually keep pace with the real inflation you're experiencing in your daily life, particularly when it comes to the specific expenses that seniors face most heavily. This disconnect between official COLA calculations and seniors' lived reality has been a source of ongoing concern for advocacy groups like the Senior Citizens League and AARP. As we discussed earlier, Social Security's COLA is based on the Consumer Price Index for urban wage earners and clerical workers, the CPIW, which measures price changes for a basket of goods and services purchased by working-age urban wage earners. The problem is that seniors spend money very differently than working-age people. Retirees typically spend a much larger percentage of their budget on healthcare, prescription drugs, home maintenance, and utilities, while spending less on transportation, clothing, and childcare. Research from the Senior Citizens League shows that seniors' inflation rate often runs higher than the general CPIW because healthcare costs, which represent a huge portion of retiree spending, have historically increased faster than overall inflation. The Street reports that even with the 2.8% COLA increase, many seniors, quote-unquote, struggle to cover rent, food, and transportation as local costs outpace national benefit adjustments. What this means in practical terms is that your $56 monthly increase might cover your Medicare premium increase with a little left over, but it's probably not keeping up with your rising grocery bills, increasing property taxes, higher homeowners insurance, escalating prescription drug costs even with Part D coverage, and all the other expenses that seem to creep up every single year. There's also significant geographic variation that the national COLA doesn't capture. If you live in a high-cost area like California, New York, or major metropolitan regions, your actual cost of living increases may be substantially higher than the national average that determines COLA. Conversely, if you live in a lower-cost rural area, the 2.8% might be more than adequate to cover your expenses. According to financial experts quoted by Empower in their COLA analysis, the real win for retirees comes when you, quote, treat each cost of living increase as a chance to strengthen your financial position, not just keep up with rising prices. This means rather than immediately increasing your spending when you see that bigger check, consider using part or all of your COLA increase to pay down high-interest debt, build your emergency savings, or invest in preventive healthcare that could save you money long-term. For your 2026 budget, the bottom line is this. Don't assume that your 2.8% COLA automatically means you can afford 2.8% more spending, because when you factor in all 7 of these budget surprises together, your actual purchasing power may be flat or even declining despite the higher nominal dollar amount showing up in your bank account. Now that you understand all 7 budget surprises affecting your first 2026 Social Security check, let me give you specific action steps you need to take right now to protect your finances and maximize your benefits. These are not optional suggestions. These are critical moves that could mean the difference between financial stability and unexpected shortfalls in the months ahead. Action. Step 1. If you haven't already done so, create or log into your My Social Security account at SSA.gov immediately. This free online portal allows you to verify your exact benefit amount for 2026, see your personalized COLA notice, check your Medicare premium deduction, and review your complete payment schedule. The Social Security Administration began sending one-page benefit statements in early December 2025 with exact dates and dollar amounts, but many people are accessing these notices online first rather than waiting for mail delivery. Action Step 2. Rebuild your entire 2026 budget using your actual net Social Security amount after Medicare premiums and any other deductions like income tax withholding, Medicare Advantage premiums, or Part D drug coverage. Do not budget based on the gross COLA increase because that's not what actually hits your checking account. Take your December 2025 net payment amount, add the COLA increase, subtract the Medicare Part B premium increase of $17.90. Subtract any other premium increases, and that final number is what you have to work with monthly. Action Step 3. Schedule a consultation with a qualified tax professional or certified financial planner before the end of January 2026 to discuss the new $6,000 senior deduction and whether you qualify. Bring your 2024 and estimated 2025 tax returns, your Social Security benefit statement, and information about any other income sources like pensions, IRA distributions, or investment income. Ask specifically about strategic moves you can make to maximize the deduction, such as timing IRA withdrawals, managing capital gains considering Roth conversions, or adjusting tax withholding from your Social Security check using Form W-4V. Action Step 4. If you're carrying any high-interest debt like credit card balances or personal loans, seriously consider applying part or all of your COLA increase toward aggressive debt payoff rather than increasing your spending. According to Empower's analysis, retirees who treat COLA increases as opportunities to strengthen their financial position rather than simply maintaining current spending habits end up significantly more financially secure over time. Even directing just $25 or $30 of your $56 increase toward debt could save you hundreds in interest charges over the year. Action. Step 5. If you haven't already done so during the Medicare annual enrollment period, which runs through December 7th, review your Medicare coverage to ensure you're not overpaying for plans that don't meet your needs. Many beneficiaries remain in the same Medicare Advantage or Part D plan year after year without shopping around, missing out on potentially hundreds of dollars in savings. The Medicare Plan Finder tool at Medicare.gov allows you to compare all available plans in your area based on your specific medications and healthcare needs. Action. Step 6. If you're working while receiving benefits and you're under full retirement age, contact the Social Security Administration immediately to report your expected 2026 earnings and understand how the earnings test will affect your payments. Don't wait until you've already earned over the limit, because that could result in overpayments that you'll have to repay later, creating a financial crisis. The SSA phone number is 1-800-772-1213, open Monday through Friday from 8 a.m. to 7 p.m. local time, or you can report earnings changes through your My Social Security account online. Action Step 7. If your budget allows, after accounting for all deductions and necessary expenses, commit to building or replenishing your emergency, your first Social Security check of 2026 is arriving with that 2.8% COLA increase, and while $56 more per month is absolutely better than no increase at all, I hope this breakdown of 7 critical budget surprises has given you a realistic picture of what you're actually dealing with financially in the year ahead. Between rising Medicare Part B premiums eating up nearly $18 of your increase, the complexity of the new senior tax deduction that may or may not help you depending on your income, payment timing that depends on your birthday, earnings limits if you're still working, increasing wage bases affecting current workers, and the persistent gap between official COLA calculations and your real experienced inflation, the financial landscape for 2026 is more complicated than most people realize. But here's the most important thing I want you to take away from this video. Knowledge is power when it comes to protecting your retirement security. By understanding these 7 surprises before they impact your budget, you're already ahead of millions of beneficiaries who will be caught off guard in the coming weeks and months. Take those action steps we discussed seriously, work with qualified professionals when necessary, stay informed through official sources like SSA, Gov and Medicare. Gov, and remember that even small strategic moves can make a meaningful difference in your financial well-being over time. If you found this breakdown helpful, please hit that like button, share this video with friends and family who receive Social Security benefits, and subscribe to Income for Seniors for weekly updates on Social Security, Medicare, retirement planning, and financial guidance specifically designed for seniors. We read every comment, so drop your questions below and let us know which of these 7 surprises surprised you the most. You can also check out our other recent videos on 2026 Medicare changes, the new senior tax deduction details, and complete COLA payment schedules by clicking the cards appearing on screen right now. Here's to a financially secure and well-informed 2026 for all of us. Stay educated, stay empowered, and remember that every dollar of your Social Security benefit represents years of hard work and contributions. Make sure you're maximizing every penny. Thank you for watching, and I'll see you in the next video.